or if you prefer, do you hear me? Okay, let me just look. Yes, sir. Hello, Prof. Okay, fine. I am very happy to meet with you again for the last time. I suppose you are very sad because it's the last session about derivatives and risk management. Okay, today's session will be devoted first to options. It's the last derivative we have to learn about. And then maybe we will prepare the final exam by some exercises. Let me just tell you that for the final exam, you will do online. I prepared different questions, 10 questions, and you have to choose 8 questions among 10. And as I wrote, please don't answer the 10 questions, only 8 among 10. I have a last question is, as the exam is online, it's very easy for each of you to do that with some friends. I know that. Okay. So I don't know exactly how I can solve this problem. I suppose you are, I can trust, and I know that you do the exam individually and not together, but I don't know. So I don't know exactly what I will do for that. Okay, maybe I will let the exam online with 10 questions, and you will choose 8 among 10. But okay, I count on you to be honest with the final exam. Okay, so before we start, do you have any question, please? Do you have any question? And I prefer that you speak. It's better for me than reading your message. So if you can speak, it's better. Okay. So do you have any question? Nobody wants to answer. Oh, I have a message in French. Très bien, monsieur. Comment allez-vous? Yunia Nguyen. Okay, that's very nice from you to speak, to write in French. Okay, so I'm doing well. Thank you a lot. And I am very happy to make the session with you. Okay, so we start with options around half an hour, 1 hour and a half, then a break, and then some exercises. Okay. First question, let me just, okay, options, first part, some definitions, and profit and loss at expiration. I just want to remind you, because I think you know a little about or much about options. You have two kinds of options, call and put. A call is an option is a financial asset, that's very important. You can buy and sell, and you can sell an option before having bought it. Okay, I can sell an option. I sell you an option. Okay, and I sell you a right that you buy or sell something to me before the expiration date. So you are not obliged to have bought the option before you sell it. You can sell an option. Okay, and banks are option seller principally. What kind of option? So it's a financial asset, which is a right to buy or to sell what we call an underlying asset in the future at a given price. The given price, the price at which you can buy or sell, is named a strike price. And traders in the world use the term strike, not strike price. It's too long, 2 words. It's strike. So you have call and you have put. A call is a right to buy an underlying asset in the future at at a predetermined price called strike price. A put is a financial asset, which is the right to sell an underlying asset in the future at a predetermined price called strike price. So you have 4 basic strategies with option. You can buy or sell option. You can buy a call or buy a put. You can sell a call or sell a put. So buying a call, selling a call, buying a put, selling a put are the 4 basic strategies with options. When we speak about options, we have also to, let me just go to the next. Okay, no, sorry. Okay. You have to make a distinction between what we call vanilla options. Vanilla, it's exactly same thing as for ice cream, vanilla. Vanilla, that means normal option, classical. I buy the right to buy the Amazon equity at $1,000 in 3 months. That's a vanilla option. That's a vanilla call. But you have also what we call exotic options. Exotic, sorry, because I have so many difficulties to write exotic options. Okay, let me just maybe do something better. Exotic option. Okay, which is an option with some specific things. Okay, so what kind of exotic options would trade in the world? First of all, what we call barrier option. Barrier, not K, barrier options. What is a barrier option? Let me just take the example of a call. The Amazon equity, okay, Amazon, assume that Amazon equity is traded at $1,000. And you buy the right to buy Amazon equity at $1,000 in 3 months. That's a normal vanilla call. But you add something. You say, my option will disappear, will disappear if at any time between today and 3 months, the equity price of Amazon is higher than 1,200. Okay, so you buy the right. Let me just try to. Okay, you buy the right. The strike price is strike price. Oh, that's so difficult. I did not remember. It was so difficult to write with this kind of thing. Okay, let me just try with that. Okay, the strike price is 1,000. You buy the right to buy Amazon at 1,000 in 3 months, strike price. But your option will disappear if a barrier, which is, for instance, at 1,200, is crossed before 3 months. It's what we call a knockout option. Knockout option. Let me just try to write that. Okay, knockout option. Knockout option. It's the right to buy Amazon at 1,000, but your option will disappear, does not exist anymore if a barrier, which is, for instance, 1,200, is crossed before 3 months. What is the advantage for a trader? It's maybe if you are sure that Amazon will not go higher than 1,200, it's stupid to pay for that. So the price of a knockout option is clearly cheaper, lower than the price of a vanilla option. But be careful, your option can disappear. Okay, so you can do that with call and put. But you have also what we call knock-in option. Knock-in options. It's the right for a call. You buy the right to buy Amazon equity at 1,000 in 3 months. But you say, my option will appear will exist only if during the next following months, Amazon equity moves up, it moves higher than, for instance, 1,200. I buy the right to buy Amazon at 1,000, but my option will exist only if the price, the equity price, is higher than 1,200. Okay? So, for instance, if at expiration, Amazon price is traded at 1,150, your option does not exist. So your payoff, what you receive at the end, is zero. You have the right to buy at 1,000, something which has a price of 1,150, but your option does not exist. Okay? But if the Amazon equity price in 3 months is 1,300, you have the right to buy it at 1,000. And you have a gain of 300. It's a normal option with a strike of 1,000. Okay? So in the world of exotic options, the most traded in Europe and United States is barrier option. Okay? So what I explaining, and one of the idea of using barrier option is to pay a cheaper price, because your gain is lower than the gain with vanilla option. You are also what we call ASEAN option. ASEAN option. Let me just, I think you know the name, ASEAN option. It's an option on the average. You buy the right to buy the Amazon equity price with a strike price equal to the average of the future prices. So if, for instance, let me just, okay, I will try to do something. Okay, if Amazon is traded today at 1,000, if it moves like that, okay, and in 3 months, here it's time, 3 months, okay, Amazon is traded, for instance, at 1,300. The average price is assume 1,200. You buy the right to buy Amazon at its average price during the 3 following months. So you have in 3 months the right to buy at 1,200, something which has a spot price of 1,300. So you have a gain of 100. Okay? So I will explain after who is using average options. We speak about average options or ASEAN option. Okay? So, okay. And you have a lot of other exotic options. But what is very important is barrier option and ASEAN options. Okay? So that's the beginning of the lesson. Okay, now a small exercise to be sure that everything is clear for each of you. Amazon equity is traded forward. Okay, you remember I have a question for you, maybe for the final exam. If Amazon is traded forward at $1,000, do you think today is traded forward 3 months? Assume 3 months. Do you think the spot price is equal to $1,000, is lower than $1,000, or is higher than $1,000? I have a question here for you, just for reminding you the last lesson. So maybe you can speak or give me the answer by message. Amazon equity is traded forward 3 months at $1,000. What do you think about the spot price? Is it higher, lower, or the same as forward? For simplicity, in my example, I assume a flat forward curve That is that the spot is equal to the forward for every maturity. That's not for clever and well-educated students as you. You know that it's not true. The forward curve for an equity is not flat. For commodities is not flat. Okay, I would like some answers from you, please. Question is the spot price for Amazon equity lower, higher, or equal to 1,000 here? I have first answer. This example you have explained in last section. Okay. I already taught options. Can answer. Give me the answer. Okay, maybe we'll go quicker if I already gave you this example. Someone is writing. Yes, we solved. Okay. Can you just answer the question, is the spot price higher, lower, or equal to the forward here? Is lower in the normal curve, and why? Why is the spot price lower? That's a good answer. Not in the normal curve. Okay, I understand what you say, but it's not exactly, it's good, but not absolutely pretty good. Yes, in the normal curve, yes. But why is the spot price lower than the forward price if the curve is normal? Can you answer? Tell me that. What is the link, the relation between the forward price of an equity and its spot price? What is the relation? Okay, someone is writing. I wait for the answer because forward is spot plus interest rate. Okay, be careful. Be careful. Good answer. Forward is spot plus interest rate plus cost of storing. Absolutely great, but it's a general relationship. In the case of an equity, what is the cost of storage? Okay, you don't have any cost of storage. But in the case of an equity, you have something specific. You are writing. I wait for the answer. Yes, dividend. And forward price for an equity is spot price plus interest rate minus dividend invested over the remaining period. Okay, so the answer you had to give me was if there is no dividend, the spot is supposed to be lower than the forward price. Exactly the answer given by one of you 1 minute ago. But you spoke about normal curve. Yes, you are right. Normally, without any dividend, you have an increasing forward curve because the interest rate is assumed to be positive. Okay, be careful because in the Eurozone, as you know, the short-term interest rates are negative. So if you ask for a forward quotations for an equity, the bank will borrow money, buy spot for hedging, and if it receives a dividend, it will invest at a negative interest rate. But in fact, it will borrow also at a negative interest rate. So maybe the forward price will be lower than the spot price because the interest rate is negative. Okay, so that's very special. So thank you very much. It was dividend minus dividend. Okay, but the good relation is forward is spot plus interest rate plus cost of trading for minus dividend in case of an equity. Just to remind you and to get outstanding grades during the final exam, don't forget something that for commodity, you can add a minus convenience yield. You remember, I study at this moment the crude oil price, energy crude oil price traded on the Chicago Mercantile Exchange, and the curve is always in backwardation. What does that mean? That means that the spot price for oil is higher than the forward price. This morning, you have an oil price, crude oil, which was close to $80, slightly higher, but we say $80. And the 3-month futures price was only 79, then 78. Say, oh, there is a very good arbitrage. I sell spot, the oil, and I buy it on the futures market, okay? And I have a gain of $2 because I sell at 80, I buy at 78. I am very rich. Be careful. Be careful, because if you do that, you don't have any more oil, okay? You have a very huge cost of opportunity. If the oil price moves up, okay, to $100 in 1 month, you are not able to sell it on the spot because you sold it before in a reverse cash and carry arbitrage. Do you remember the name? Reverse cash and carry arbitrage. You sold at 80 to buy back at 78. You have a gain of $2 plus interest rates, because when you sell spot, you receive $80. You can invest them in dollars at a positive interest rate, okay? And you have inventory capacities you can rent, and you can add your gain. But actually, today people don't make reverse cash and carry arbitrage because they think that the oil price could go higher. And maybe with you, I don't know, but some weeks ago, the oil forward curve, futures curve, was already decreasing, was already in backwardation. And I told students, be careful, if the market is in backwardation, it means that traders think that the oil price could go up. And if you look what happens during the last weeks and months, the oil price has moved up a lot, okay? Today, the curve is something like flat, okay? Not really a huge backwardation, but it means that people think that the oil price maybe could go higher, okay? What is very sad is that we cannot confirm in 1 month because it's the last session today. So it's not possible that I tell you, okay, in 1 month, we will see if the oil price has moved up. So you will look by yourself. Maybe you send me an email, you were right, or you were wrong, okay? So I don't know, but what we can say. Okay, maybe if we did already that, I will not solve this exercise. You have all the slides, and you can by yourself, or some of you want that we quickly go to the answer, or can we go further? Nobody answers. Okay, so if you buy a call at expiration, you have this kind of profit and loss, P&L. Okay, so buying a call. Selling a call. P&L at expiration, buying a put, and selling a put at expiration. All these strategies are at expiration. Okay. I have a question for you. Did we do already this exercise? You buy a call 3 months, strike K. You sell a put 3 months, strike K. Forward price is named F. The price of the call is C. The price of the put is P. The spot price of the asset is named S, and its cutoff carry only the interest rate I. The price of the call is C, and the price of the put is P. What is the P&L at expiration of the options portfolio? Write the relation between all the variables K, S, F, I, C, P. Did we do that already? I don't remember, but maybe I did. Maybe I don't remember very well. No, I remember very well. Did we say that or not? If you can answer, please answer. I know that it's something like 7:30 p.m. in Vietnam. Maybe you have your dinner now, and you say, okay, I will make a dinner, and I will. Okay, can someone answer? Did we do this exercise already? You said just yes or not. Yes or no. Nobody wants to answer? No. Great. Okay, no. So it's just, I look at the, let me just look at, okay. Before this exercise, I suppose that you know that draw the P&L at expiration, selling a call, buying a put, selling a put. You know that very well. And did we do these two first exercises? Tell me just yes or no. Okay, and item 3. Yes, okay. Exercise 3 and after 4, okay? So I give you, during your dinner, 2 minutes. You buy 2 minutes, you eat and you have a sheet of paper beside you and you work during, you eat and you work. You buy a call, 3 months, strike 1,000 on Amazon, and you buy a put 3 months, strike 1,000. Each option has a price of $50. At expiration, Amazon is traded at 1,050. What is your result? At expiration, Amazon is traded at 1,300. What is your result? And draw the P&L at expiration. Today, not today, at this moment, we just draw profit and loss at expiration. But I will explain after that when you use options, your time horizon is not expiration, is today. And as every option trader says in the world, each day is a new day. So if you buy a 3 month option, you have immediately an exposure, and the price of your option will move up or down between today and 1 minute, 1 hour. So your time horizon when you use options is never, no, can be, but it's not good that the time horizon is expiration. So it's the reason why all the pictures at expiration, the profit and loss at expiration are really at expiration. But we will see after that it's better if we consider that the time horizon is not expiration. Okay, I give you 2 minutes for the third exercise. You buy a call, you buy a put, the option has a price of 50, each option. At expiration, Amazon is traded at 1,050. What is your result? As soon as you have your result, you stop eating and you write the solution on the message. Okay, so I am waiting for the solution. Normally it's 30 seconds for the for the three questions. Nobody wants to answer. Everybody is dining, is sleeping, dining, playing cards. The option is very interesting. Nobody wants to answer. Okay, please answer, because it's, you have to think about my exposure. I am in my office with just a small computer. I have slide on my computer. Nobody, I don't see anybody. I don't hear anybody. Is it very sad? Okay, can you give me? Nobody wants to answer? Please, someone is required to answer. Okay, Tweetram, thank you very much. I am waiting for some answers. I buy a call. Okay, what is the question is, what is your result? What is your profit and loss? Okay, maybe I understand, but okay. Today you buy a call already. You buy a call today, you buy a put today. Maybe you mean I exercise the call, no? Rather than buying a call. Some one of your colleagues, I cannot spell the name because it's too difficult for me. If I say Tweetram Anne Nguyen, I'm not sure that everyone is understanding what I am telling. Just call me Anne. Oh, great. Anne. So what is your answer, Anne, for the first question? You know, I speak very fluently Vietnamese. Anne. Minus 50. Okay, that's good. That's very easy, but that's good. Okay, so for everybody, if you buy a call today and you buy a put today, it's what we call a straddle. Yes, sure, a straddle. This strategy, cannot write. Really, you have to invite me next year. I don't know where, maybe in your bank. And okay, straddle, okay. It's buy a call, buy a put. So if you buy a call, yes, okay. Exercise the call. Okay, if the price is, for instance, 1,050, you have the right to buy at 1,000. You exercise the option. You receive Amazon at 1,000 because you buy at 1,000, and you sell it on the spot market at 1,050. You have a gain of plus 50. Okay, fine, but you pay for that $50 for each option, so minus $100. And if you want the best mark in the world, you have to say 1 plus, because you pay today the option, 1 plus interest rates times time, which is here 0.25 because it's 3 months. Okay, so your result is 50 minus 100, which is the sum of the price of options, 50 plus 50, borrowed over the period. So that's roughly minus 50. And so congratulations to Anne. Anne has a good answer. But someone else, I don't know how to call her or call him, I don't know, Tin Ngok Mai Tran. For the second question, say plus again a profit of 200. I think it's good. That's outstanding. That's not so difficult, but that's good. Okay, you exercise your call. You buy Amazon at 1,000. You sell it spot at 1,300. You have a gain of 300. Okay, so second question here. Second question. You have a gain of 300. But you paid at the beginning 100. 1 plus interest rates times T, which is the time to maturity expressed in year, which is something like 1 divided by 4, which is 0.25. Okay, so the good answer here is 200. And congratulations to T Ngok Mai Tran. Okay? May. Okay, you can call me May. May or May. Okay, May, Mai, I don't know. Okay. Congratulations. Then draw the P&L at expiration. I have to use something to wish. I don't know. I'm okay. Okay, good. What is the P&L at expiration? Okay, I will do that with the computer mouse, so that's not so easy. P like profit, L like loss, 0 like 0. Here you have Amazon, the Amazon equity, Amazon at expiration, the price of Amazon. And here you have 1,000. Okay, so if you buy a call and that at expiration, the price of Amazon is lower than the strike price, your gain is 0. You bought the right to buy at 1,000. The price is lower than 1,000. Sorry for you, you have a loss of how much? Of minus 50, because you paid the call 50. If you want to be outstanding students, you say, no, professor, I don't agree with you. It's minus 50, 1 plus interest rates, because you borrowed for buying an option. I say, yes, I am not a good professor. I was wrong. I forgot the interest rates. Okay, so, and now if the price of Amazon is higher than 1,000, you sell it at expiration at the spot price, S index T, which is the spot price at expiration, minus 100, minus 50. 1 plus interest rate. So you have here what we call a break-even, which is at 1,050. So I put here 1,050, 1,050. The slope is 1. The slope is 1. Okay. So you can say at expiration, don't forget it's at expiration. You have a break-even. If you buy today a call, Amazon, you have again if Amazon is higher than strike price plus the option price. Now you do the same thing with the put, because you bought put. If you buy a put with a strike of 1,000, and if at expiration the spot price is higher than 1,000, you have the right to sell at 1,000, something which has a price which is higher than. You will not buy at a higher price and sell at 1,000. Maybe if you are stupid, but nobody is stupid here. So you have a loss, sorry for you, which is minus 50. And if the price moves down, you buy in the market at a lower price, for instance, 950. You sell it at 1,000 because you have the right to sell at 1,000. You have a gain of 50, but you paid 50. So you have here. Okay, it's the profit and loss on the put. And now, if you add the two pictures, buy a call, buy a put, here the slope is -1, here the slope is 0. So the slope is -1, the P&L, the global P&L is like that. And here, it's the gain on the put minus the loss on the call. And here on the right, you have a gain on the call and a loss on the put. So your global result, profit and loss, is the gain on the call minus the loss on the put, which is something here. Good. It's like that. Okay? And your global loss, if Amazon equity price has remained at 1,000, did not change. Okay, strange assumption, but okay, you have a loss which is your maximum loss of minus 1,000. Okay, and here you have what we call break-even, which is 1,100, and here which is 900. Okay, so the P&L of a straddle, that's a very well-known strategy. What is the name for this strategy? When? What is your expectation if you do a straddle, if you buy a straddle? If you say, I buy a call, I buy a put at the money, which is the strike price is equal to the forward price. So what is your expectation here? I will ask you, please answer. Anne, May, and all the people can answer. Oh. I want just one word. One word. What is your expectation expressed in one word? Yes, sure. Volatility. Volatility was the good word, and volatile as much as possible. I agree with that. I wait for Anne because Anne is writing something. We are waiting for her or his answer, but no answer. Maybe because it's too easy and the answer has already been given. No, Anne is again writing. I don't receive the answer. Okay. Maybe it's an answer with, oh, they only have to bear limit loss. Okay. I'm not sure to understand very well what you are writing here. For buyer role, for the buyer on an option, they only have to bear limit loss. I would like to understand what you are telling here. Are you telling that if you buy an option, your risk is limited because you pay the price and you cannot lose more than the price? Is it that you are telling? If it's that, that's okay, but I will after teach some new things. Is it what you want to express, or do you want to tell something else, Anne? I speak with Anne. Okay, Anne, you answer, and after we. Okay, so That's very easy, this kind of question. Okay, another question now, exercise 4. And during your dinner, maybe you did not finish to have your dinner. Maybe that's a moment for dessert. Okay, I don't know, maybe you are eating something, chocolate cake or something like that. Okay, you buy a call, strike K, and you sell a put, strike K, same strike. I don't know, I don't tell you that the strike is at the money, out of the money, in the money, it's just same strike. Point price is F, like forward. Price of a call is C, price of a put is P, a spot price is named S. What is the P&L at expiration of the options portfolio? And then write the relation between all the variables. Okay, I would like some answers quickly. You buy a call, you sell a put, same strike. Look at the P&L at expiration. I give you 3 minutes. And you work during your dessert with chocolate. Maybe for some of you who don't like chocolate, they are eating dessert with coconut. Probably some of you are eating coconut during my lesson on option. Okay, I give you 2 minutes more. So it's a last session, but maybe you could answer quickly, more quicker than usually, because it's the last session. Tomorrow it's finished. No more derivatives. Okay. Nobody wants to answer. I am obliged to give the answer. It's not too difficult. So, as I already know the name of two of you, Anne and me, or Mai, I don't know, me or Mai, and Anne, can I ask them to give me an answer? Sometimes T Fong, no, that's Anne, sorry. Someone else is yes, T Fong Anne Lee. Okay. Is answering. Can you answer? Maybe you are a little tired, no? You have a very hard day? Or the dessert with coconut is not good? Okay, let me give you the answer because nobody wants to answer. I am very sad, very, very sad. Okay, because I'm sure you are able to give me K plus C minus P exponential of RT. That's a good answer. Very good answer. Everybody understands this answer, or do I have to explain? I am sure nobody will answer, so I will explain quickly. Now, okay, congratulations. We can really, okay, Anne has a right to get a second dessert because it's a very good answer. Okay, how can we check its answer? Okay, let me just, I will wish. Okay. Okay. At expiration, that is at time t, we have two, what we call in economics, stage of nature, three assumptions. The spot price at expiration, which is named S index T, is higher than K. Or spot price at expiration is lower than K. Or S spot price at expiration is equal to K. No other opportunity. If the spot price at expiration is higher than K, you bought a call, you exercise your call, and you buy the asset, you buy at which price? At K. Because you have the right to buy at K something which has a price of spot, which is higher. You buy at K. But for that, you have to add the price of the option you bought, the price is C, minus the price of the option you sold, the put. And here, borrowed or invested over the period. So if you buy a call today, you sell a put, you keep your exposure till expiration. At expiration, the spot price is higher than K. You can buy your asset at K. And the buying price is K plus the price of the call you paid minus the price of the put you received. And as your colleague wrote, with very outstanding notation, exponential, I will use that because I love exponential of interest rates time t. T is equal to, okay, 3 months. It's 0.25, it's t is 3 months, okay? But here it's t. That's great. Now, if at expiration spot price is lower than K, you have the right to sell at K. You sold to someone, you sold to someone the right that someone is selling at K. If the price is lower than K, the guy will go to your home and say, okay, I sell you at K. You are obliged to buy at K. So in this assumption, you buy again at K, but for that, you pay at the beginning C, price of the call, you receive P, okay, over the period exponential of RT. And if at expiration the spot price is equal to K, you can buy at K. Same thing. K plus C minus P, okay, exponential of RT. So now you understand that if you buy a call today with a strike equal to K, you sell a put with the same strike price, you are sure 100% probability to buy at expiration at K plus C minus P, price of the call minus price of the put you sold, invested or borrowed, it depends if C minus P is positive or negative, exponential of RT. So the question is, if you buy a call, strike K, you sell a put, strike K, what are you doing? This strategy with options is what we call in finance replicating, because I will try to write that. Okay, buying a call, A plus selling a put, Whoa. A, P, same strike, same maturity, is replicating, is equal to, is replicating what? Please, a word. I would just want a word. Is replicating what? Is replicating what? Just a word. If you buy a call, you sell a put. As you see on my slide, you are sure to buy at K plus C minus P exponential of RT. So what is this strategy? Buying a call, selling a put is equivalent to, or if you want to use smart words to be smart in the options world, you say it's replicating, it's equal to what? Please give me the answer. What is this strategy? Who is sure to buy at a given price? It's what? It is replicating or is equal what? Nobody wants to answer today. It's a silent day. You decided among you not to speak, and you say, okay, we don't speak during this session because it's a last session. Someone had the idea to speak, to write. Someone was again Anne. Anne again is writing. We are forward price. Sure, it's buying forward. But sure, if you buy forward Amazon, you are sure in 3 months to buy Amazon at a forward price, okay, at F. And what is F? If you want to be outstanding, F is S times exponential of RT. Whoa. Exponential of R times T minus dividend, but okay, minus, okay. So by arbitrage, as buying a call and selling a put is strictly equivalent to buy forward. What is the relation we have? Let me just someone was also writing, okay? So by arbitrage, I will try to write something. Okay, by arbitrage, buy a call. Yes, Professor, may I ask why is C minus P but not P minus C? Sure, you can ask me. You can ask me for every question, okay? Sometimes I cannot answer. I tell you, I don't know. Okay, here I know, okay? Because in my strategy, buy a call, selling a put, you buy a call, so you pay. The guy who buys an option, he pays to the option seller. And when you sell an option, you sell a put, you receive money for the buyer. So when you buy a call, when you buy an option, maybe I forgot to tell you, but I assume that you knew that. When you buy an option, you have the right to buy something or to sell. So you pay for that. That's the price, okay? And if you sell an option, you receive money from the guy who bought the option. Okay, so if you sell me, you are a student here. Sure. Okay, got it. I don't go further because you understand very well. Okay, so So by arbitrage, buying a call, strike K, maturity T, whatever is K, whatever is T, you can, what you want, plus selling a put, just same strike, same maturity, okay, is equal buying forward. At A plus, we agree, C minus P times exponential of R times T. Okay, but by arbitrage, it's buying forward. So this relation, so K plus C minus P times exponential of R times T. My arbitrage has to be equal to what? Are you writing something? We don't see your writings. Ah, very interesting. Yes, I am writing. Nobody see what I am writing? No, sir. Oh, yeah. Sorry, because I was, okay. I already drew a lot of things. You did not see my graphics before? You did not see my graphics? Nothing. Okay, so I have to, okay, sit now. Okay. That's so strange, this computer. Ah, yeah, yes, disappear again because I use the garbage to eliminate my, okay. Graphics before, yes. Ah, yes, I think it takes a little time to show up. Yeah, sure. Okay, I will try again because it's so important. Okay. Okay, I write something and maybe we wait till tomorrow to see if it appears on your slide. No, we wait some 1 minute. Okay, so what I was, you can write on your paper. What I was writing is that, okay, sorry, because, okay, buying a call. Sorry, because I have to, oh la la la. Ah, sorry. Ah, that's so strange. Okay. I am okay. We can wait till the next exam. Sure, you can do that. Okay. Let me just try to do something. Okay, I try again to write the thing, and maybe okay, you can write on a sheet of paper, and after we can see buy a call. Okay. Do you see buy a call? Again, buying a call here, buying a call. I am just writing buy a call. Do you see that or not? Buying a call. Just buying Sarah. Just buying a car. No, okay. Normally I was writing. Okay, so you can write on your paper buy a call plus selling a put with the same strike and maturity, K and T. Buy a call, strike price K, maturity T, plus selling a put, same strike, same maturity, is equal to buying, you are sure to buying at K plus, you can write that, C minus P exponential of R times T. Exactly the formula given by your colleague some minutes ago, okay? So if you buy a call, you sell a put, you are sure to buy at K plus C minus P times exponential of RT. Okay. But that by arbitrage has to be equal to the forward price, because what you are doing is a forward. If you buy a call, you sell a put, you are sure to buy at K plus C minus P times exponential of RT. So this price is necessarily equal to the forward price. Okay? So if F is the forward, equal K plus C minus P times exponential of RT. Do you see on the slide now or not yet? Not yet. Sorry for that. So on your sheet of paper, you write forward price F, you write F. Maybe on the way. Yes, sure. But it's a long trip between us and you. Sorry, it's a too long trip. Maybe it stops at customs. Maybe they ask for the sanitary pass. You tell me just when you see the formula. Yes, I can do that in the chat. Okay. F equals F forward price equal K plus C minus P times exponential of R times T. Okay, do you receive that's okay in the chat? Okay. Okay, fine. Okay, we yeah, that's the customs. Yes, yes. So you see now. Okay. So if you see that, I continue in the chat because what can we learn from this equation? It led me to Vietnam. So thank you very much. So what we can write now is that C minus C minus P, the difference between the price of a call and the price of a put, same strike, same maturity, sure, equals F minus K exponential of minus R times T. Not too difficult. C minus P equal F minus K. So last, whoops, sorry, because, okay. Oh, I don't know. Okay. Very high level mathematics, okay, from the equation C minus P. So you obtain the very well-known equation here. It's the price of a call with strike price K maturity T equals the price of a put K T plus F minus K exponential of minus R times T. I send you the formula here. I try to do that. Oh, it has disappeared. Okay. Yes, that's okay. So the price of a call is equal to the price of a put plus F minus K times exponential of RT. So what do we see immediately from this equation is that For at the money options, that's an option with a strike price which is equal to the forward price. Here, 1,000 for Amazon equity. The price of a call is equal to the price of a put. That's what we call the very well-known put-call parity theory or equation. That is put-call parity, which is the price of a call is equal to the price of a put if the strike price is equal to the forward price. So the price, the right to buy Amazon at 1,000, which is its forward price, is equal to the price to sell Amazon at 1,000. Okay? When you see this equation and you speak with traders in trading rooms, you know, traders, they say, okay, I know if the market will move up or if the market will move down. Okay, I say it will go up, it will go down. I stop them and I say, hey, guy, do you know the put-call parity? No. I explain quickly. Put-call parity, you buy a call, you sell a put, it's buying forward. And if you introduce a very easy equation, the price of a call is equal to the price of a put if the strike is the forward. So if Amazon is traded at 1,000, the right to buy it at 1,000 exactly equal by arbitrage to the price to sell it. So that means that the expected spot, the best expected spot price for Amazon in the future is its forward price. Because if you thought that Amazon would go up, normally the price of a call would be higher than the price of a put. Sorry, by arbitrage, the price of a call with a strike price equal to the forward price is equal to the price of a put. So how can you say the market thinks that the price of Amazon will move up if the price of a call is equal to the price of a put? If anybody knew that Amazon would go up, everybody would buy calls. The price of the call will move up higher than the price of a put. Or here you have exactly through this equation. What does that mean? That the forward price is equal to the expected spot price. So if you ask me, do you think that Amazon will go up or down? I say 50% that Amazon is higher than its forward price and 50% it's lower than. So that's my answer. I don't believe to expectations. I know that it's very difficult to accept this idea, but look at this equation. If traders thought that the price of Amazon will go up, they would buy calls, and then the price of a call would go higher than the price of a put. And in fact, it's by arbitrage the same price. So in reality, if people thought that Amazon would go up, already the forward price would have gone up. And at this price today, it's the best expected spot price. And you can, for people who like theory, they can read someone I love as an economist who has been a Nobel Prize, which name is I will try. When I write with my pen, do you see immediately? Do you see that F? Do you see F, for instance, immediately or not? I see. Okay. So I will write with my mouse. Okay, Eugène Fama. Okay. Read Fama. It's very interesting. Okay. He wrote something which was Fama, F-A-M-A, Eugène Fama, who has been Nobel Prize for his work on what we call efficient capital markets, okay, informationally, okay, efficient market, and capital market, and his idea is that the best expected spot price is the forward price. and he explained that very well. So it means that you cannot make expectation with a positive expected gain, because if you win, you have 50% if you buy to make money, 50% to lose money. I like this idea. So okay, we will stop here now. But for people who like thinking about these topics, please read Fama. His paper is in, because he wrote a lot of papers. His basic paper has been written in 1970, and it's efficient capital markets. Very interesting. Okay, so if you want to exchange about that, I will give you my email before we leave. I am so sad, and I hope you also. I will give you if you want to exchange after. Don't hesitate. I love markets. Okay, so fine. I look at okay. Maybe we make a break in 15 minutes. Okay, so that's very interesting. That's the forward price is equal to K plus C minus P expansion of RT. Okay, so we saw that a lot. Okay, exactly the answer. If you buy a call, you sell a put at expiration, you can exercise your call and buy Amazon at K. Cost of buying, K plus C minus P expansion of RT. If it's lower, same thing, you sold the put. The guy who bought the put, the guy or the woman who bought the put, sells you Amazon at K, and you are obliged to buy at K. And if the spot is equal to K, you can buy at K. Okay? We observe that in any state of the nature, the arbitrager can buy Amazon in 3 months at K plus C minus P exponential of RT. To buy arbitrage, I repeat, an arbitrage is a gain without any risk. This price has to be equal to the forward price. So by arbitrage, everything has been already written here. Price of a call is equal to the price of a put plus the difference between forward and K. Okay? If the strike price equals the forward price, what we call at the money options for European options, the price of a call is equal to the price of a put. The relation is named put-call parity. Okay. I love this question. Before the break, I love this question. Assumptions. Be careful and be prepared to the question. Amazon equity forward price, very good. We know what is forward price. It's spot price plus interest rates minus dividend. If I am on commodity plus cost of storing minus convenience yield. Okay, we know a lot of that. Congratulations. You are really now an expert. Amazon equity forward price is traded at $1,000. Price of European coal at the money is around $50. Be careful. You buy a coal at the money, that is strike equal 1,000 equal forward price, and you pay for that $50. Okay, that's no, it's not strange. Immediately, looking at your Bloomberg screen, because I hope that you have in your home, everyone has a Bloomberg screen close to your TV. You bought a Bloomberg screen, and you see Amazon moves up to immediately, sorry. You pay $50 to your bank, to Vietcom Bank, I remember, Vietcom Bank. You pay $50 to buy the right to buy Amazon on 1,000. And immediately you look at your screen, Amazon moves up by 49. And it's now traded at 1,049. My question is very important. I want that everyone answers. Everyone. For people who don't answer, it's minus 7 points for the final examination. Okay? So minus 7 or minus 8. I don't know yet. Are you happy? Are you not yet happy? You paid 50. The price moves up immediately to 1,049. Are you not yet happy, but pretty soon, or are you unhappy? I wait for, a lot of students now answer because they say, is it a joke that I lose 7 points if I don't answer, or is it not a joke? So now you are asking your friends and you say, do you think it's a joke? And maybe, I don't know, maybe it's not a joke. Maybe we lose 7. You don't lose any point, sure. Not yet happy, but soon. It's May. Not yet happy because at page 50. Yeah, I wait other answers. I wait for remaining answers because you are a lot. Not yet happy, still soon. Okay. Okay. Nobody gave me a good answer. If you want to understand options, it's very, very important what I will explain now. Imagine that instead of buying a call on Amazon, you think Amazon will move up. Instead of buying a call, you buy spot Amazon. You buy Amazon. Okay? The equity. You pay $1,000 because the price of Amazon is 1,000. You pay 1,000. And if I tell you the price of Amazon does not move immediately, it stays at 1,000. What is your profit and loss, immediate profit and loss? Nobody will answer minus 1,000. Yes, you paid 1,000 for buying Amazon, but if Amazon does not move, your result is not minus 1,000, it's just 0. And why is it 0? Because you can sell, your Amazon equity. You can sell it. So, for an option, it's absolutely fundamental to have the same approach. An option is a financial asset. You can buy, you can sell. If you buy an option, you pay 50. Sure, you pay $50. But you have an option. You have an asset. It's not an equity. It's not a bond. It's not rice or wheat. Its name is an option. So in your balance sheet, you have minus $50 in cash, but you have in your balance sheet an asset with a price of $50. Now imagine that the price of Amazon equity moves up to 1,049, as in my example. The price of your call has moved up because now the right to buy Amazon at 1,000 in 3 months. And the price is now 1,049. The price of the call has moved up. It's higher than $50. It was $50 when Amazon equity price was 1,000. If now you have the right to buy at 1,049, you have the right to buy at 1,000 something which has a price of 1,049, its price has moved up. Its price is higher. So you have a potential gain. You have a potential gain. It's exactly as if you buy Amazon, you pay $1,000 and the price of Amazon moves up by $20. You can sell your asset with a gain of $20. Here you can sell your option with a gain, which is not $49. It will be lower, but the price has moved up. So that's very important to understand that. You are very happy. As soon as the equity price moves up, the call price moves up. Here, I am not at expiration. All the graphics you see in books, you see in some courses. And when you say, okay, if I buy a call, I acclaim that. And we did that. And I have a break-even of 1,050. That's right, but at expiration. You remember, I told you these pictures, these graphics are at expiration. But now, if you buy a call and that the price of the call of Amazon moves up, the price of the call moves up. You have a gain because you can sell your option at a higher price. Please, before leaving this course, before having an advanced knowledge about options, don't forget that. If you use options as a hedging tool, as a trading tool, the price of an option moves with the price of the underlying asset. If you buy an option, a call, and the price of the underlying asset moves up, the price of the call moves up, you can sell it at a higher price and you will make money. That's very, very important. Profit and loss is not cash flow. When you buy an option, you pay the price. Some people speak about premium. I don't like premium for an option because premium is for an insurance company. If you want to insure your car, your house, you pay a premium, an insurance premium. But you cannot, it's not a financial asset. You don't have any market for buying and selling an insurance. But you have a market for buying and selling calls, like for an equity. So your immediate profit and loss, if you buy an option, is zero because you paid, but you have in your balance sheet an asset. You can sell it your asset. If the price moves, of the underlying price does not move, you can sell it at $50 and you have a P&L which is zero because an option is a tradable asset that you can buy and sell at any moment. Okay? I expect that Amazon equity will move up and is traded forward at $1,000. I buy a European call, I pay $50. Sure, I pay $50. As I can sell immediately my option, the immediate profit and loss is not minus 50, it's zero. And I sure, but I have for sure a cash outflow of $50. Yes, I pay $50. But I buy something which is a financial asset. It's not an equity, it's not a bond. Its name is option. Same thing. Very, very important. Before going that, let me just use 5 minutes for explaining something. I am okay, maybe, sorry, no. I'm looking for a blank page. Oh. Let me just, sorry. I will use maybe that, okay. Let me just show you something. That's the price of a call. That's a call. If you buy a call here on the horizontal line, I put the forward price. And here I put the strike price, K. If you buy a call with a strike price which is lower than F, you buy the right to buy Amazon at $900 and its price is $1,000. You buy the right to buy Amazon at $500. Its price is $1,000. If you buy a call with a strike which is lower than the forward price, your option has a minimum value which is equal to the difference between F and K. It's what we call the intrinsic value of the option or the arbitrage value, okay? And the slope here is +1, okay? Here, if you buy the right to buy Amazon at K, which is higher than F, I buy the right to buy Amazon at 1,500. I buy the right to buy Amazon at 1,200. There is no arbitrage value. You cannot make an arbitrage if you have the right to buy at a higher price. So the intrinsic value or the arbitrage value is 0 here. Okay. So the first element of the option price is a maximum between 0 and the difference between F minus K. Okay. If F is higher than K, you pay the difference at minimum, but as you pay today, and it's exponential of minus RT. Okay. So, okay, that's the definition of intrinsic value. Now, an option price is divided in two components: intrinsic value, plus what we call time value. Okay, so for option with K, an option which has no arbitrage value is named out of the money. It's out, an out option. If K is higher than F, you buy the right to buy Amazon at 1,200. The higher is the K, the lower is the option price. So here you have something like that. What we call the time value, okay, is if K is higher than F, for instance, you buy the right to buy Amazon at 1,200, or you buy Amazon a call 1,500. So this option is very cheap because the right to buy at 1,000, something which has a price of 1,000 today, 1,500 against 1,000, the probability that your option gives you money at the end is very, very low, because the probability that Amazon price is higher in 3 months than 1,500 is very, very low. So the higher it's K, the lower is the option price. The option price is never 0, because in the theory, it's possible that Amazon moves up to, I don't know, $10,000 in 3 months. We don't know. The probability is very, very small, but in a normal Gaussian world, it's possible. Then, for reason it's difficult to explain in short time, the time value of the option decreases also when the option here becomes what we call in the money here. So you have an option price, which is something like that. So if you buy the right to buy at 1,000, okay, no arbitrage value. The price is only time value. The price is $50. We saw that, okay? So now, sorry. I will. That's so difficult. Okay, I will. Okay, so quickly, call is something like that. You buy Amazon, the strike is forward, it's at the money option, it's you buy the right to buy at 1,000. The price is $50. That's the price of the call. If you buy it, that's P&L now. P&L, profit, 0 loss. And you put here the forward price of Amazon 1,000. And here it's forward price. Here it's forward. And here it's the price of a call. Okay. Do you see my graphics or not? Just tell me quickly. Yes, okay, thank you. If you buy this option, you have an immediate exposure. If the price of Amazon moves up, for instance, to 1,001, you paid 50, and the price moves up by 1. For people who don't understand options, not you, but people of other universities, they say, oh, I have a loss because I paid 50 and Amazon price has moved up only by 1. No, you tell the students no. Why? Because if the price moves up, the price of Amazon moves up. The price is now here. Okay? Because that's the price of a call is an increasing function of the forward price here. And for instance, you have again of the price of a call has moved to 50.5. You have again of 0.5, for instance. Okay? Depends of what? It depends on the slope here. Okay, I will explain after. So here, if the price of Amazon moves up, you can sell your option at a higher price. That's a gain for you. That's a gain. That's gain. You are very happy. Even if the price is at 1,001, the option price moves up, you can sell it with a gain immediately, not in 3 months. And you have a gain. So that's a gain. So your P&L is here. That's exactly that. Okay. And now if the price of Amazon moves down, the option price moves down also. Because the right to buy at 1,000, something which has now a price of 900, is lower. The price has moved down. You have a loss, potential loss, which is that. So here. Okay. That's your P&L. At 1,000, your P&L is 0. I buy a call, I pay 50, but as I can sell my option immediately, if Amazon price does not move, my P&L is 0. Moves up, I make money. Imagine, moves like in my example to 1,049. I am very happy because the option price has moved up. It does not matter that I paid 50. I paid 50, something which has now a price which is higher than 50. And before the break, the last thing to know now is, what is my gain? You gain. I have no time to ask you the question, but how can you estimate your gain? Mathematically, your gain will depend on the slope of your curve, on the derivative, which is change in the call price divided by change in the forward price, which is what we call the first partial derivative of the call according to the forward price. And this derivative is very well known in the option world. We can bet together. I bet how much? $5. Oh no, $10. That if you go in a trading room where you have an options desk, if you have some traders, you stay 5 minutes beside the desk. I'm sure I bet $10 that the name of the derivatives will be given by traders. This name is very well known, is delta. Delta. It's a Greek letter. Okay. Delta is the derivative. It's the change of the call price according to the change in the forward price. That's what is important for the option trader. If Amazon moves up, how much do I make money? If Amazon moves by 10, does my option, my call moves by 5, 12? and the derivative, the delta, will give you the delta of the derivative is included between 0 and here, if you look, 1. And normally, the derivative of your option, if you buy an at the money option, you buy the right to buy Amazon at 1,000, it's around 0.5. For people who know well the options, it's not exactly 0.5, but it's really, really close to 0.5. What does that mean? That means that if you buy today, during the break, you buy a call on Amazon, 3 months, you will pay $50. If Amazon moves to 1,050 in immediately, not in 3 months, immediately, you pay 50, you come back to your home for the lesson, and because the lesson is not finished, okay, maybe you are sad, but the lesson is not finished, and you look at your Bloomberg screen and you see 1,050. For people who did not follow my course, you say, oh, my result is 0. I paid 50. Amazon is now traded at 1,050. I have a gain of 0 because I paid 50. For people who followed this course, they open a bottle of champagne. Why? Because if Amazon moves up, you have here the slope. The derivative is a slope. And the slope is 0.5. What does that mean? That means that if Amazon moves up by 50, your call will move up by 25. And in fact, slightly higher than 25, because your curve has a second derivative, which is positive, it's a convex function. So you have again, which is slightly higher than that. And you can open a bottle of champagne. You paid 50, but now you can sell your option something like 75. Okay? Because if the price moves up by 50, you have a derivative which is 0.5. You have a gain, a linear gain, which is 25, plus a term of convexity. So you have a gain which is slightly higher. Honestly, if you want to keep just some things about my lesson on options, keep that. That's so important, because many people think, I pay 50, I just make money if Amazon moves up higher than 1,050. No. If Amazon moves up to 1,001, you make money, because you have a derivative which is 0.5, you have a gain which is $0.5. Okay, dollar. So that's very important. That's really very important. Do you have any question before we stop now for beer, for champagne, or what you want? Do you have any questions, or is it clear for anybody? I wait for answers. You can tell me I did not understand anything, or I understood everything. I discovered something I did not discover because I already knew this story. Anne is writing. Okay, it takes a long time for coming from Vietnam to France. Is it easy to find the delta? Oh, good question. In fact, to find the delta, you have to know the equation for the option price, the equation. and the delta is the derivative. So it's not in my course, but for people who want to know that, I don't know, I think I have that at the end just for showing. Let me just, no, I did not. Okay, if we, okay, I answer, but it's not something you have to learn. The option price with what we call the Black-Scholes formula, which is a theoretical model, which is used everywhere in the world. Everybody use Black-Scholes. The price of a call is this equation, okay? So it's not so easy to understand why it's this equation. But the delta is DC divided by the either according to the spot or to the forward. And then you have the equation, I think, here. No, I did not do. Okay, if you make the first derivative of this equation according to S, be careful you don't obtain immediately n to d1 because d1 depends on S and d2 depend on S because d1 is that and d2 is that. Okay, so that's not really, if you want some more explanation about theoretical aspects of option pricing. So the delta, okay, I would like to answer quickly. For option traders, the delta is very easy to compute, but you need to have a computer because the equation is, as you see, a little complex, okay? So if you are able to make the derivative of that according to S or according to forward, because in the Black-Scholes formula, there is no dividend and the forward is just S exponential of RT, okay? That's a forward because there is no dividend, okay? So if you make the first derivative of C according to F or to S, you have a delta spot, a delta forward, you will find an equation, okay? And this equation is a delta. And the delta is included between 0 and +1, as you saw. And at the money, you obtain something which is close to 0.5. But to know the delta, I answer your question, you need to have a computer because the computation of the derivative is not easy because the equation is not easy, okay? So, but it's really very, when you know how to compute the delta, it's very easy. It's just you push your button and you have the delta, okay? So, I cannot maybe go further, but okay, if you want other explanation, please send me an email after and I will give you all the papers used for computing the call and computing what we call the Greeks. It is the derivative because you have other derivatives. You have a derivative according to time, to volatility, to a lot of things. So, but really, it's not the objective of the course to make you immediately experts on options. It's a too long way to learn about options. But if already you understood that when you buy an option, your profit and loss, immediate profit and loss is 0 and not minus price, really you are pretty good because very few people think that when you buy an option, your profit and loss immediate profit and loss is 0. Everybody tells me it's minus the price of the option, minus the premium. No, no, and no. Okay, other questions before the break? The break. Okay, it's close to 9:00 p.m. by you. For me, it's close to 4:00 in the afternoon. So I don't have any other message. So we make a break, not too long, in order to stop not too late. I propose that we meet again at 4:05 in 15 minutes. and I wish you a good dessert. You can send me by message your dessert because I love Vietnamese desserts. Okay, so don't hesitate to send me your dessert by message. Okay, so in 15 minutes. Okay, last part of the last session. My idea was to make some exercises for preparing the final exam, better than going deeper on options. Okay, so about option, what you have to know is it's financial asset. You can buy or sell, call or put. First, 4 basic strategies. You have vanilla option and exotic options. Then, if you buy a call and buy a put, it's named a straddle, and a straddle is a volatility strategy. And essentially, we saw that if you buy an option, your immediate P&L is 0 and not minus the option price, or more horrible, the option premium. Okay, you pay, but you have an asset. You can sell it at the price you just paid. Okay, so when you buy an option, it's exactly, if you buy a bond, if you buy an equity, your P&L is 0. You make money if the price of the option of the equity or of the bond moves up, and you lose money if the price of these assets moves down. Okay, so something I would like also to tell you, because some of you ask me questions about the documentation. Okay, the documentation is huge. Okay, you have a lot of pages, and I did not explain everything in details. That's normal. I answer only questions about what I really taught. For instance, one of you asks me about the relation between futures and spot. Okay, I just give you, as you can see on the message, what does that mean till the relation is again verified. If you have, for instance, we take the present data. The forward price in Chicago, expiration date December, is traded at $80. Imagine that, and the cost of carry of storage for oil is around $1 per month. So we are 2 months before December around. Okay, 2 months. So the cost of carry is $2. Assume the level of interest rates over a 2 months period is 0, to be clear. So normally, if the forward price is equal to $80, the spot price should be something like $78. Okay, 80 minus $2 cost of carry. Imagine now the spot price is equal to 70 and not 78. The cost of carry is $1 per month, and the futures price traded in Chicago is $80. What do you do if you work in an energy company, in a trading room of an energy company? You buy spot energy, you buy oil at 70. Immediately you sell it, you sell a future at 80, and you store your oil during 2 months. Cost of buying oil is 70 plus $2 cost of carry, and you sell at 80, so you have a gain of $8. $80 minus 70 minus $2. Okay. What I wanted to explain here is that it's a very easy arbitrage, what we call a cash and carry arbitrage. I buy the cash, I sell the future. If you do that, the spot price will move up because every arbitrager will buy spot oil and sell it forward or future. So the spot price will move up from 70 to 71, 72, 73. And the futures price, which is traded at 80, will go down because everybody will sell it. So 80, 79, 78. At a moment, the difference between the futures price and the spot price will come back to its equilibrium level, which is $2 cost of carry. So maybe the spot will go to 76. The futures price will move to 78, and you will get a difference of $2. Okay, it's exactly what I wanted to explain. One of you asked me to look at I don't remember, but it's a page on which I explain in details the table of I don't remember. I will look with you. The slide is no. Okay, I don't remember, but okay. Normally, if I did not go into details about some slides, it's not useful to go by yourself into details. Okay, just you go through. Okay. Maybe we could go to some exercises for preparing, and I will tell you some more details about that. Okay, so I prepare for you some exercise. If I find them, okay. Yeah, for instance, about options, you have a lot of slides, and I did not explain everything because we did not have time enough. Oh. Okay. Before the end of the session, some exercises to be prepared for the final exam. Everybody has to get an outstanding mark. Okay, for instance, with what kind of exercise I can give you? Here, it's the oil price on the futures on the Chicago futures market, and as you see in the last column, prices delivered in October 5. Okay, just 1 week ago. November contract is traded at 77.82. December 77.53. January 202. It's only 77.06, 0.66, 76.42, etc. So my first question, and maybe you can immediately answer by your message: how do we name a decreasing commodity price? Maybe if you want that we go on a lot of questions, maybe you have to answer quickly because, okay, it's very. If you don't answer, I am obliged to stay and we just see some questions. So my advice would be that everybody answers quickly, and after we go to the other question. Backwardation. Fine. Okay. Everybody has to know that when a commodity futures curve is decreasing, that is, you have a reverse cash and carry arbitrage, the curve is named backwardation. And then it's named contango. Okay. So second question, on the commodity market, write the equation before the futures price and the spot price. Okay, quickly. For people who are very familiar with everything, maybe they immediately write the message, such as everybody looks at the answer. Futures is spot plus cost of carry plus interest rate. It's good, but not pretty good. Yes, it's pretty good. Minus convenience yield. Don't forget that, okay? because on commodities you have minus. Because normally, if you don't see if you don't add convenience yield, normally the futures price would be increasing with maturity, because the futures price is equal to spot plus cost of carry, and the cost of carry is increasing with time, because it's more expensive to store oil during 6 months than 5 months, than 4 months, than 1 month. Okay, so normally a futures price should be increasing. But here, as for oil on my slide, you have a decreasing yield curve because we are in backwardation. So we have to subtract something from the equation, which is called the convenience yield. Perfect for that. Why is the price curve decreasing? The answer was because people expect that the price will move up, so they don't want to make a reverse cash and carry arbitrage by selling spot and buying futures at a lower price. Okay, if I work with Total Energy, I work with Total Energy. I look at the price. I sell my oil at, for instance, today 78, because November is 77. So the spot is close to 78 at this moment. And I buy it at March 2002 at 75.73. So I have again close to $2. I sell at 78. I buy back future in March at 75.33, if I look. Okay, but why don't traders do that? Because they say, if I sell spot my oil and I buy it back in the future, I lose the opportunity to sell it at a higher price. So if you think that market price will move up, you don't make the cash and carry arbitrage. Okay, that was exercise 1. You can ask question. Only one question. No, 2. You make an interest rate swap on $100, pay a fixed rate 2%. 1 year later, the 9 years fixed rate has moved up to 9%. Is the value of your swap positive or negative, and what is its value? For people who are very familiar, you go immediately to the message. Everybody can look at the answer, and okay, and we go quick to the exercise 3. You know, this kind of question you will get. I answer for, I expect answers. I'm waiting for answers. Okay, positive. Okay, yes, the answer is positive. Why? For everybody, you have a swap. It is you have a contract by which you will pay each year during 10 years 2% of $100 million. Okay, and we save what you want, LIBOR 6 months. 1 year later, the 9-year fixed rate has moved to 9%. What does that mean? If you sell your swap, it has a huge positive value because you have a contract by which you will pay each year 2% and receive variable rate, and the new swap pay 9% and receive the variable rate, the same as you. So the variable rate is the same in the new swap and in the old swap, but in the old swap you pay 2%, And now people pay 9%. If you want to sell your swap, you will receive, you will tell the guy who is buying your swap, hey, ho, guy, in my swap, I pay 2%, I receive variable. In the new swap, you pay 9% and you receive variable. So the difference is that you have a gain of 7%, 9 minus 2, each year during 9 years. So the equation was something like the mark to market, the positive value is sum from year 1 to 9 of 9% minus 2% discounted 1 plus yield power t times 100 million euro. $100, sorry. Okay, so 7% during 9 years without discounting. It's $6.3, 7% times 9. It's it's 63%. So it's $63. Okay, 63. But you have to discount with 9% interest rates, so it's much lower than $63 million. Okay, so you have to make the computation. So, okay, do you have any question, or is it clear for everyone? Don't hesitate, it's the last moment for asking your question. Okay, everybody would have all the points for this question. Okay, I assume yes, because you don't answer. Yes. Great. Thank you a lot. Okay. I don't know if we spoke about that. What does that mean, that the settlement on oil futures price is deliverable? That means that if you buy a future on oil on the Chicago Mercantile Exchange, the contract is, as maybe you can see, is deliverable. That is that if you buy oil, expiration date December, for instance, if you buy one contract is 1,000 barrels. So if you buy one contract on Chicago, December 21, in fact, you buy 1,000 barrels of oil at a price, futures price, which is, I don't know here. The contract is deliverable. That means that if you want to resave at expiration the oil, you can do that, because you buy forward future oil. So if you want, you can be delivered, or you can sell your contract before expiration. Okay. Okay. Maybe just a small story. I don't know if we spoke about that. In April 21 last year, not 21, sorry, in April 2020, not 21, just after the beginning of the pandemic crisis in the world, oil prices, futures oil prices, became negative, till something like minus $35. So people who bought future oil futures contract paid minus. He received money when buying oil. Why? Because on the futures market, a lot of people were long futures contracts. They bought futures contract on oil. They bought. And if they go till expiration, as the contract is deliverable, they're obliged to resave oil because they bought oil. And if they don't sell their contract before expiration, as they bought oil, they will be delivered oil. And at this moment, in April 20, the level of inventories was of storage capacities, for instance, was very, very few. because nobody, the capacities of storage were well full. Okay, so if you receive oil, you could not store it. Okay, or with a huge cost, and all the people wanted to sell their contract before expiration because no storage capacities. So as the cost of storage was so high, till $40, the price of the oil moves down negative to something like $40. Okay, I accept to sell my contract by paying $40 because if I don't sell my contract, I will receive oil and I will be obliged to store it at a very huge price, $40. Okay, so it's the reason why. The other method for you can either sell your contract if you buy, that is cash settlement, or physical settlement, you deliver the commodity. Oh, very, very okay. You have here, I don't know if because my slide is not very, I don't know why. Okay, cocoa futures quote. That was in 2016, an old table, but very interesting. Here you have a curve which is about, okay. What is the name for this commodity price curve? The good answer is backwardation, okay? So be careful, maybe you will get a question with backwardation. I repeat that the opposite of backwardation is contango. Contango. It's when the commodity curve is normal. Contango. 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 It's the opposite of backwardation. It's a normal curve, contango. So what is the name? Backwardation. 1 point. What is the price? Why is the price decreasing with maturity? Do we expect a bad crop? Do we expect a good crop? Or is it just a discounting effect? Good crop, good crop. Are you sure? Good crop? Are you sure? What does that mean that the market is in backwardation? It means that nobody wants to sell its cocoa now for buying it in the future. Why? Because you expect that the price will move up. Do you remember for oil? If you think that the cocoa price will move down, you can sell spot and buy it forward. You don't have any opportunity cost. But if the crop is expected to be bad, few production, few supply, you expect that the price will move up. You don't want to sell your inventory with reverse cash and carry arbitrage. You don't want to sell spot for buying in the future at a future price. If you do that, you make money, sure. It's a reverse cash and carry arbitrage. But you lose the opportunity to sell your cocoa at a higher price during the arbitrage period. So the good answer here was bad crop. I'm very surprised that you told me good crop. Could you explain me, for instance, because if you don't want to sell spots, it's because you think that the price will move up. If you think that the price will move down, you prefer to make a reverse cash and carry arbitrage, you sell spots and you buy in the future. Have you any explanation for your answer? Maybe something? No? No. Okay. Someone is writing. And you understand now or not? Yes. Okay. Okay. Look at the futures curve. December is traded at 2,900. March 17 is traded at 2,875. Then 2,868. And December, at the end, at the last line, is 2,851. So the curve is decreasing. If you look at that, you are working in a big company like Glencore, trading company, commodity trading company, and you look at these prices. You say, okay, I can make money if I sell. Imagine that the spot price, the spot, imagine is traded at 2,900, for instance, 920. Okay, so December, it's 1 month after, it's 2,920. It's 2,900 December, and then the price is moving down. Imagine you are working in a commodity trading company. Okay, it's your job now. You say, oh, I can make money. I sell spot cacao. I sell spot. You know what is it? Because you have cacao. You sell spot at 2,920. Plus, immediately you buy a future. You buy what you sold spot today. You buy a future. December, for instance, December 17 here at 2,800, for instance, 50. You have a gain of $70. This gain, the operation you are running, is called reverse cash and carry arbitrage. You sell spot, you buy future. Okay, you sell what you have, and you will buy back in the future in 1 year around. Okay, because it's between around December or November 16, and the end of arbitrage is December 17. So if you sell spot your cocoa, it's very, very easy to understand. You don't have any more because you sold. You have a gain of $70, which is sure, it's an arbitrage gain. You will gain in December, you will gain $70 because you sold today at 2,097 and you buy a future at 2,850. So you have an arbitrage gain of that. But if you do that, you don't have any more your cocoa. And imagine that in 15 days, in 2 months, the cocoa price moves up a lot to, for instance, $4,000. $4,000. You cannot sell it at $4,000 because you sold your cacao already. So what you sold for an arbitrage cash and carry, you reverse cash and carry, you cannot use for selling it in a trading objective. So if you sell spot for buying future, you have an opportunity cost. You lose money if the price moves up. So you prefer to keep this decreasing curve than, in fact, to sell spot, to buy that in order that the curve moves up again. So when you have this kind of futures curve, it's because the market expects that the price will move up. So if the price will move up, it's because the crop is expected to be bad. Okay? I don't know how to. Yes, I know. You have some rice. I'm sure you are very huge rice consumers. You have rice and pepper in your dining room, in your kitchen. Imagine that you can sell your spot, what you have in your kitchen, at I don't know, $2, and buy it back in 1 year at $1.90. So you can sell it at $2 today, your rice you have in your kitchen, and buy it back at 190 only in 1 year. Okay, so the same quantity, the same quality of rice. You say, if I do that, I sell spot, I buy future, I will make a gain of 10 cents. Of 10 cents. That's very interesting. Okay, so, but if you think the rice price will go down, you can do that. But if you think that the rice price will move up to $10, you don't want to do that, because you have a sure gain of 10 cents, but you lose the opportunity to sell the rice you have in your kitchen at $10 in the coming year. So when the market is in backwardation, is because people prefer to keep their rice in their kitchen than to sell it and buy it and buying back in the future. Okay, so and why? Because you expect a very bad crop on rice. Someone told you, oh, the crop will be horrible, there will no rice in the world. Okay, you prefer to keep your rice at home than selling it spot and buying it future with a gain of 10 cents. So the curve will be in backwardation. Okay, can you explain again? Did I explain again? And did you understand what I explained with the rice in your kitchen? I am waiting. I wait. I see some. I can explain again. Okay, I don't receive it yet. And it, but I don't see that in the chart. No. There is no expectation in the table. Just if you have this kind of futures price decreasing, a decreasing curve, you are sure that it's because the market does not want to make a reverse cash and carry arbitrage, because he thinks that the market will go up. So you don't see any chart. It's just when the curve is like that, you expect that the price will move up. Look at the oil price. The oil price is exactly like that, and the oil price has moved up since some weeks, because nobody wants to sell it for buying it back. Because when you sell for and buy it back, you lose the availability of the commodity. You lose the availability of the commodity. Okay? Yes, you just look at the number. Yeah, sure. Yes. Okay. Okay, that's so easy. It's Bloomberg. You have bid and ask. What does that mean, bid and ask? That's a price at which the market maker is able to buy, the price at which the market maker is able to sell. And normally, no, the bid price normally is always lower than the ask price, because that's just oh, I like this kind of exercise. Explain without computation why the price of the zero coupon bond 5 years, okay, third line, 5 years, is roughly equal to 103.45. Okay. I wait for answers. Okay, it's a zero coupon bond. Okay, because here it's obligation, it's a bond with a coupon which is zero. Okay, so if you buy it, you will receive zero during 5 years, and then you will receive 100. The price for this bond is higher than 100. That is, people will buy at 103.5 and receive in 5 years only 100. They will get a negative interest rate. The yield is negative, minus 0.663%. Okay? How can you roughly estimate this price and say, okay, that's a good price without any computation? Okay, I wait. Very good, Tong Win. I don't know how I can name you. Tong Win. Probably it's not very good. Some of you tell me, call me Anne, call me May. You did it right, 0. I understand. What does that mean, 0? Okay, I don't understand what you are writing. I mean, you are right. Okay. Thank you. Okay, so how can we obtain that? Remember, a bond with a coupon equal to the yield, coupon equal yield, you have in your manual equal yield, has a price of 100. If a bond has a coupon equal to the yield, its price is 100. What does that mean? That means if a bond had a coupon, a negative coupon of minus 0.66%, its price would be 100. If the coupon was minus 0.66, was negative, its price would be 100. Here it's a zero coupon bond. So if you buy it, as the price of a bond with a negative coupon would be 100, you will pay more than 100. How much? Each year you have a gain of 0.66%. Okay? During 5 years, times 5, normally you have to discount each flow each year, but roughly, because it's without any expectation, we are here around 103, 100, a little more than 103. That's okay. That's 5 times 6 is that. 6 times 3, okay. Around, okay, that. Okay. Fine. Okay, very good. Compute the duration. Okay, I don't make an exercise about duration. Okay, that. And after maybe we stop and we make a discussion about the course and the final exam. Yield curve, continuous time, 1 year 1%, 2 year 2%, 3 years 4%. Compute the 1 year in 1 year, the forward 1 year in 2 years, and comment. Okay, it will be the last exercise before dancing, because it's time for dancing quickly. And I wait for your answer before dancing. Okay, I look, some of you are preparing the answer. I see that you are writing. I did not receive yet your answers, but I wait. Okay, 1 year and 1 year is 3%. Okay. Okay, maybe I think it's okay. I think congratulations to 3%. Yes, Thuy, Tram, Anne, and Nguyen confirms that the good answer for the first question is 3% with all the explanation. Okay, we look at the answer, which is very good. Okay, I like this last answer. If you 1 year in 1 year, okay. If you lend over 1 year period, in 1 year you have exponential of 1%. You lend again over 1 year in 1 year over a 1 year period at a forward rate. So exponential of 1% times exponential of the forward rate we are looking for times 1 because it's 1 year equals lending over a 2 years period. Don't forget this arbitrage relation. Lending over a 1 year period and reinvesting over a 1 year period at the forward rate has to be equal to lending over a 2 years period. And if you lend over a 2 years period, you obtain exponential of 2 times 2%, which is the 2 years continuous time. So you obtain 3% because with logarithm, you obtain the forward rate is equal to 2 times 2%, 4% minus 1 is 3%. Absolutely great. If you have not understood, you know the name of these outstanding students and you call them during the night and you tell them, okay, I did not understand very well. Can you explain me again? You do that at 3 o'clock in the night. That's a good idea for awakening the student. Then for compute the 1 year in 2 years, it's equivalent to lend over a 3 year period or lending over a 2 years period and then lending over 1 year in 2 years at the forward. So if I look at the formula which has been writing, lending over a 2 years period give me exponential of 2 times 2%. I agree. Then I reinvest over a 1 year period, exponential between year 2 and 3 times 1, because it's 1 year, is equivalent to lend over 3 year periods. So equivalent to exponential of 3 times 4%. And then you obtain 8%. I did not check, but I am sure that it's okay. I don't need to check, okay? So, and I check here and I see that it's good, okay? That's perfect, okay. If you are wrong on the final results, it has no consequence. What is important is to be able to write the equation. And here the equation is very well written. Okay. So I look if I have another last question for you, or if we can stop here. Oh yes, I like. You don't know how to comment. I saw how to comment. Ah yes, I don't know yet. I don't know why yes, maybe what I wanted to here comment was maybe when the yield curve is increasing, the forward rates are higher than the spot rate. Okay, so the 1 year in 1 year. Okay, today the 1 year is 1%. The forward 1 year in 1 year is 4%, and the 1 year in 2 years is 8%. So what does that mean? That means that you have a very steep yield curve, and with forward rates which are very high, and in the expectation theory, the forward rate is equal to the expected spot rate. So if you have this kind of yield curve, that means clearly that traders expect a rise of interest rates because the forward rate can be considered as an expected spot rate. Okay, so okay, please help. I try to help. Oh, you can immediately highlight this question. Does the relation futures price, spot plus carry, apply to equity? I don't like my question because normally it's spot, yes, spot plus carry. Ah, yeah, no. Yes. For equity, does it apply? You tell me yes or no quickly. Okay, I give you the answer. Yes, for equity, it's okay. It's spot plus carry is interest rates minus dividend. For rice, sure, it works. Future is spot plus cost of carry. For weather indices, if you buy temperature, rain, snow in the future, sure, it does not apply. The futures price of temperature in Madrid or in Hanoi, August 22, is not equal to the spot temperature in Hanoi plus cost of carry. That's stupid. So the futures price for temperature for weather derivatives is essentially linked to expectations of temperature at the contract expiration. Electricity, no, because you cannot store electricity. So if you want to buy electricity in 3 months, you cannot say, okay, I buy spot electricity. You can do that. I store electricity during 3 months. You cannot store electricity. It does not apply at electricity. And emission allowance, I don't know if you know the market for emission allowance, but yes, because you have a spot market for emission allowance and a futures market. If you want to buy a futures market and emission allowance, you borrow, you buy spot, and you keep. You don't have any dividend on emission allowance, sure. Okay, so it applies also to emission allowance. So I think we can stop here because it's time to go to dance. Can you explain about weather buying? Yeah, sure. If for instance you are producing beer, beer, okay, beer, okay, because it's very very hot and you like beer, Chinese beer, Vietnamese beer, I don't know. Okay, if you are a beer producer, you have a risk that the weather is bad because the beer consumption is very highly correlated with temperature, beer and temperature. Okay, so I know firms in Europe, temperature, who hedge the risk that the temperature moves down, because if the temperature moves down, the consumption of beer will move down. Let me just give you a figure. For 1 degree change in Madrid, okay, in Spain, as you know, in Madrid, in Spain, Madrid, Spain, 1% change in temperature is minus, if the temperature is minus 1%, not minus 1%, minus 1% according to the average temperature. For instance, let me be clearer. In next August in Madrid, we expect the temperature will be around 25 degrees Celsius in August in Madrid, next August. If the temperature is only 24 degrees, the level of beer consumption will move down. And know that for 1 degree Celsius change, the level of consumption beer moves down by 7.5%. And it's linear. If it's only 23 degrees Celsius, you have minus 15%. So what is the problem for a beer company is to hedge against a decrease of the temperature. Is the reason why we created what we call a weather derivatives market, on which you can buy and sell temperature. For instance, the beer producer will sell temperature. It sells temperature at, for instance, 25 degrees Madrid next August. If at the end of August in Madrid, the temperature has been only 23 degrees, okay, that's the observed temperature at the end of August 22, okay, in 9 months. If the temperature only been that, okay, you sold at 25, you buy back at 23, you have a gain of 2 degrees Celsius times the value in euro of in dollars or in euro of 1 degree Celsius, for instance, 1 million euro, and you have a gain of 2 million euro. But you have a loss because you sold a lower quantity of beers because the temperature has only been 23 degrees instead of 25, and you're low, and you have a minus 15% consumption of beer minus. So you lose on your business, but you gain on your hedge. Okay, so it's what we call a weather derivatives market, which is active because a lot of industries are weather sensitive. Beverage, okay, sure, beer, what you want, but also energy, because the consumption of energy is very well correlated to temperature. The leisure industry, okay, the leisure industry, a lot of industries are correlated. Okay, so we leave now. It's very sad. I hope you are very, very sad to leave the course. You will get your exam. Don't be afraid. It will be questions as I raised today. Do the exercise individually, okay? If I see 2 copies with exactly the same answer, I'm obliged to say, oh, is it really an individual copy, or students did that together? Okay, so please try to do that individually. It's better. Okay. Okay, for me it was really a big pleasure to speak with you. I love Vietnam, as I told you a lot of times. And I hope you enjoy the course. I enjoy myself. Don't hesitate to send me an email. I will give you again my email, and after we leave, my email is Marteau, Marteau, at escp.eu. Okay, but I think you have. Okay, or you can send me a message on the existing system we are today. I will stay some minutes if you have some questions to raise. So or you can send me an email, Marteau, Marteau escp.eu and I will answer. Okay, have a nice night. Good preparation for the examination. If you have questions, don't hesitate to send me an email, and I will stay for minutes if you have something to tell me by message. It was a very big pleasure for me. I hope for you too, and good dinner, good dance, good TV watching. Okay, honey, bye bye.